Hey everyone, in this video I'll show you how you can build a consistently profitable setup with our trading bot, even when using a time-based chart. For this, we'll take a look at the ES, we'll use the 5-minute chart, and we'll start by looking at the most recent 20 days. That means if I set anything up, of course it also has to have worked consistently over the last 20 days. Only then can I, of course, go even further back into the past to optimize it more thoroughly for past conditions. First of all, of course, I always need to have a very clear idea. That means I need to know exactly what I want to set up. That also means I need to know what kind of setup I would like to have and what exactly needs to happen. In this example, I would like to have the bot trade as soon as we actually leave the Asia range. Yes, that means we either break out downward or we break out upward. That means if it breaks out downward, it should open a short position. If it breaks out upward, it should open a long position. All right, so we've got the idea for now and we'll move on to implementing it. So first, we're going to load the bot in here and display all of the signals. That means I'm going to select only the volume right here, remove everything else completely, and then activate the separate filters. After that, I go into our range filter. I want to clearly define the Asia range, and in this example, I set it from 12 a.m. to 8 a.m. Normally, I'd handle it a bit differently if I were doing it by hand, but since we don't want to do it manually, we of course have to give the bot something that actually makes practical sense. And if I go from 0 to 8 a.m., I also have the first two 4-hour candles covered, which of course also increases the probability that if we leave this range, we'll then continue further into the trend. After I've done that, I also set how long the range is supposed to remain valid. That means we want it to remain valid at least up until 11:00 p.m. And that also means, of course, it will only show me the signals that occur within that specific time period. Okay, yes, that means we've now set the range everywhere. That works properly now. Yes, we can also give the range a name right here now. We'll do that as well now too. And they usually just refer to it as the Asia range. Okay. So that means we now, of course, only want to trade the breakouts coming out of this Asia range. And for that, we, of course, need to tell it exactly where it's allowed to go long and exactly where it's allowed to go short. Of course, I also want to keep him from just briefly peeking out of this range and then immediately going straight back in again. That means I specify a certain minimum distance for him to move. And I tell him how many ticks at a minimum he needs to move out of this range. So after we've defined that, it means we've established the upper side first, and now we're defining the lower side as well. And as you can see, most of the time the stock markets are generally rising, yes, and that applies to the indices too. And here's a special point explaining why I set up the short setup a little differently. I want to trade the direct retest of this range. That means I'm not trading the breakout right now, where we're supposed to have at least a minimum distance. I'm putting a clear restriction on it, meaning it's only allowed to look for short trades within an area of no more than 30 ticks below this range. Okay, after I've set that, I'll first take a look at what the whole thing looks like here, yeah. And I can see, sometimes the market just goes down and then turns back around. To avoid that, I'll just bring in one more time frame into the chart here. That means we're basically going to take a slightly closer look at our high and low filter here. And I'll just switch over here to the 4-hour time frame chart. And here, of course, I can now specify a bit more precisely where it should actually look for trades. That means I don't want to trade these breakouts, but instead I want to trade the retests. That means when the market comes back again. All right, so I activate the whole thing and then set a restriction right here. And I say that up to the low within a 60% range, you're only allowed to look for long trades. And I do essentially the exact same thing on the short side as well. That means I'm telling it there too. You're only allowed to look for short trades as long as it stays within that 60% range. So that means I already have a few signals here that don't look all that bad, at least at first glance. And of course, the very first thing I can do here is simply run the back test. We download the tick data for this. And here we can already see the result. Yes, that means the setup is profitable for now. Of course, we set a 1-to-1 ratio here, but we also see that the market drops quite quickly at this point, and from here on it begins to reverse. The win rate is at 50%, and we have a risk-reward ratio of 1. Okay? So that means we now, of course, need to go into the trading signals for a moment and take a closer look at what's happening here, for example. Yes, and where exactly are the nice signals? So now, for example, I can clearly see here that the market is moving downward. We have a really strong negative delta, and then I have a positive delta right here. That means the market is moving upward here. This is definitely something that I personally really like. Yes, that means I might go ahead and set this up right here for now. That means I'm going back into our trading bot now and taking a much closer look at the average delta. Yes, that means I'm setting this to period 1. That means we're looking closely at each individual candle, and I'll just show you this right here using this example. Yes, for example, I could set it right here from 1800 all the way up to 5000 or even up to 8000 if you'd like. And then we can see that at least for now, we're of course not getting any kind of signal because we've also set this specifically to the 4-hour chart here. Now I'm setting the offset. That means I want to look at the candle next to it. The adjacent candle therefore shows a fairly strong negative delta of 1800. I'll just quickly show the cross check. If I now move it up to 1850, the signal disappears. That means 3 ticks above here. Okay, of course I don't want to go that high. This might be a special case here. I mean, of course we can test it. If I move this up to 1800 here and just leave it set like that, I'll probably end up getting very few signals. We really don't need those anymore. But even at that point, I can see, okay, the signals that come in are definitely already very good. So that means even here with a 1-1 ratio, the whole thing would still be profitable. I could, of course, set the risk management here to 2. That means we're aiming for a 2.1 ratio, and I can see that it still stays profitable. A win rate sitting at 54%, but paired with a risk-reward ratio of 4.2. Why does a risk-reward ratio of 4.2 come about? That's, of course, where you look at the stop-loss trades. And those were apparently considerably smaller than what we ultimately ended up making in profit. Okay, yes, like I mentioned, that's still relatively few trades at the moment. That means I may want to generate a few more trades overall. So what do I do next? Go back into the average delta and just lower it a little bit here, maybe down to 1000, and then let it run through again. And I'll definitely end up generating more trades. Even with a few losses, that's not too bad right now. We'll simply take another look at those a little later on. I'll lower the delta even more down here now. So, and now I'm getting 42 trades in total with 19 winners and 23 losers. And yeah, I think we can definitely work with that. That means if we keep on starting to filter a bit further here to see, maybe we can filter out a few more things as well. Of course, we get even fewer trades here, but that looks pretty good so far. All right, I'm just going to move this a bit over to the side, and then we'll first take a closer look at what these trades actually look like. Yeah, so here I have, for example, a few nice trades. Here I have a nice trade, here I have a nice trade, and here as well a very nice trade. We're also currently in a strong long trend. Here I've got a pretty nice trade. Up here he also made a really nice trade, but it ends up running overnight. That means I would need to filter that out here by first specifying that it should close out all trades at 10 p.m. Let it run through again now. Okay, of course I could also have it closed a bit earlier. As we already know, 9:45 p.m. can definitely get pretty wild again. I'll close the earlier ones first. Okay, good. That already looks already quite decent. Yes, of course, I could also try taking a closer look here at our range filter to see whether the 30 tick distance maybe isn't a little too much, because we've now done one thing as well, using the 4-hour chart that we brought in again here as an additional help. You could, of course, check whether you might be able to lower this a bit. I'll just have it for now. That means I first have to take a look at how the result develops. So I have 43 trades here, and the result isn't really getting much better. Yes, that means we'll go ahead and do a quick cross check here as well. I'll bump it back up to 30 again. Yes, so I definitely did end up with more trades, but the question is, was the overall result actually better? 39. Let's just set it off to the side for the moment. Here again at 15. So we're looking at 43 trades, 44. Yes, the risk reward ratio has remained the same overall. It has gotten a little bit better right here now. Of course, I also have a noticeably higher total number of trades. That means, of course, it's just one more winner, but also 3 more losses. And then I naturally have to consider whether that really makes sense or whether it actually makes even less sense. Yes, but everyone is free to decide that too. I can play around with it a bit more here and say, okay, let's go up to 20 or 25 ticks. So it gets worse again here as well. Yes, that means I'll just leave it at 30 for the time being. And I'll go ahead and take a look at a few more trades so I can first see where we might possibly be able to take something out if it's actually needed. Yes, for example, we see such an extremely small candle here, no movement in the market. Of course I can say, how big is it exactly? 28 ticks. Yes, if you look closely, the other candles are of course all a little bigger, which of course also suggests that momentum is coming into the market. Unfortunately, I end up getting stopped out here. The candle itself is also relatively small in size. Here too, I could of course take a look now and say, okay, let's first set the minimum candle size here and say, okay, a candle like this has to be at least, I'd say, 30 ticks in size, and for the short direction also at least 30 ticks. And then, first of all, we're going to take a look at what actually happens. Yes, and that means we have definitely gotten out of the trades now, but the profit has essentially stayed about the same. That means we'll take another much closer look to see where there might be any possible mistrades. Yes, here we have a rather small losing trade. Okay, here we need to take a much closer look at the stop levels. That means, of course, we can say here that we'll set the stop once again and specify, for example, 60 ticks. So a minimum stop size of 60 ticks. The problem with that, of course, and now we can also clearly see what's changing here, is that in the end, we ultimately end up with a somewhat larger drawdown as a direct consequence. It's simply because even with a risk reward ratio, RRR, that we've set at 2:1, we don't always actually end up hitting that exact 2:1 level. On a time-based chart, the candles are, of course, always varying in size, And as a direct result, the SL and the TP also always end up being different when we look at it purely in ticks. We can, of course, take a look here as well, meaning that here I could, of course, say, hey, after 50 ticks, please move to break even, okay? And then we'll simply take a look at how it looks. Risk management here as well, moving to break even after 50 ticks. I'm at 10,000. Yeah, so we can clearly see the result is going down. I have relatively quite a lot of break-even trades. Of course, I could also say, okay, if you were already 50 ticks in profit, I want to make at least 25 ticks. But we can clearly see that it's basically not getting any better here. And of course, we also need to think about whether we should leave that out for the time being and, if necessary, optimize it in a different way first. So the result here actually doesn't look bad. 17,000 is still 17,000, but of course I want to avoid these drawdown phases. Of course, I also need to look at the whole thing from a historical perspective. That means that just because it's been going relatively well lately, it still doesn't mean it's necessarily going to work going forward, right? We naturally have a fairly strong uptrend here, which essentially means that at the moment we could trade this particular setup relatively well. We'll just switch up to 40 days now, and then we'll take a much closer look at the result. We're downloading the tick data again. We've set relatively little here. Yes, that means we specified a location, we specified the candle size, and we specified that the candle before it must have at least a negative delta of 500. You can still play around with that. So now we're at 40 days, and we can see this is still that drawdown we had here the whole time. Here we had a period where things went well, and here again a period where things went worse. So we have 47 trades, 31 winners, and 16 losses with a hit rate of 65%. That's not too bad to start with. Got it? Next, I'd first like to see precisely where the POC is. That means we'll start by taking a closer look at the exact location of the POC, and I don't want to trade directly against the POC. That means I want to trade away from the pull key, so I'm activating the entire thing. I need to take it out again. That means I don't want to have it displayed. I don't need tick data anymore there. So now I'm only going to trade away from the POC, not against it, only away from the POC. And now I have 25 trades, of course noticeably fewer than before. But I have 19 winning trades and only 6 losing trades now. I have a CAV of 1.75 and a hit rate of 76% over 40 days. So, okay, that already looks quite good. Yes, it's definitely a profitable setup. And here too, of course, I can still go a little bit higher. Yes, now let's go up to 60 days and take a quick look at what it looks like over that period. Here too, I just need to quickly check the tick data again. So not very much really changes in the result here either. It's still 20,000. Okay. Let's take a quick, fairly brief look at the data right here. 1, 2, 3. In February, he made 3 trades. In March, he made relatively quite a lot. And here, of course, he also made just a few. And of course, we can also simply go through this here now. Yeah, we'll go back to the very beginning here and take a closer look at why he actually makes relatively few trades here. Well, that's of course one thing, here with the short breakout, we've set the range right here. So point A actually wouldn't even be reached yet on the 4-hour candle. What we can of course do here now is simply apply these settings to the 1-hour candle so that we can then see whether the result here perhaps improves a bit or gets a little worse, right? That means we'll just go ahead and stick with the 1-hour candle for now because maybe that way we'll get a few more setups. But even here I can see the result is getting worse. That means we'll just stick with the 4-hour candle here. Okay. Of course, we can try again here to see if we can still squeeze a bit more out of it with risk management. For example, I can go to a 3-1 here. We have an SL of 60 at a 3-1 ratio. Well, I can already see that the drawdown is of course increasing quite significantly here. That means that here as well, I could of course say that we'll try to manage the whole thing by using a trailing stop. And I'll just say, of course, it's a little more difficult to determine exactly at what number of ticks it should start trailing. So that means just enter 70 ticks for now because I think a 2.1 ratio should definitely have been around 70 ticks if the candle is supposed to be at least 30 ticks in size. Instead, we end up here at 17,000. That's not better than what we had earlier. Here as well, I can of course try to see whether I can make that work a little better with a move downward. Or if I move it a little further upward, neither of those two really changes all that much overall. And so, of course, I can now start thinking a bit more carefully about how I set that up. That means I can, of course, set the risk-reward ratio to 2 here again. And then just check, do I actually get to 16 here now? Now, of course, I'm going to throw this out again. So here I end up at 19. That's basically the best result I have at the moment, and I really haven't optimized very much yet. That means we only specified a single location, told it how many stops it needs to have, and that was basically it. And of course, the previous candle should be quite strongly negative. You could, of course, try tweaking the whole thing here again using the average delta and say, let's see what happens if the previous candle is set to only 400. We can see the drawdown is increasing. We don't want that. Nevertheless, it can, of course, happen that if we go down even further, we'll then get even more setups. It can happen, and then, of course, the whole thing can improve again. We could potentially get back up to around 19,000 here as well. Of course, we do have a few more trades right now, but the win rate has also decreased just a little bit. Of course, we can take another look here. What exactly do we have here? Yes, we do actually have a candle here that briefly takes us out. Here as well, we could of course do one thing and say, okay, we will of course move the stop again a bit so that something like this doesn't happen here. And we go ahead and do that right here as well under risk management. And we tell it, please just move the stop by 10 ticks. That is, of course, possible now as well. That means basically it has always made sense to place the stop a little bit higher up or simply just above the candle in order to give the market a little more room. But overall, this already looks very, very good. Yes, that means we tested 60 days. I'll just let this run through again briefly. 22,000, 2,400, 23 trades in total, and 10 of those ended up being losers. Yes, of course, you could definitely continue to look a little bit deeper into the losing trades, but even if I go ahead and run these 60 days here with 3 micros, yes, that's still $6,000. Yeah, $6,000, whether that's with three, four, five, six, or even 10 accounts, that's still a pretty substantial amount of money. Yeah, and with a single setup here, I'm taking on relatively low overall risk. Yes, that means I can, of course, apply this exact same setup to other markets as well. Of course, I would then need to adjust the order flow values, meaning I would have to adjust the absorption candle, and I might also need to adjust the range just a little bit. But other than that, I definitely do have the option to adapt this setup across all the other markets I want to trade too. Yes, and if I do that across 10 different markets, then I've already covered quite a lot with just one setup. Yes, like I said, it's still a single setup, and I can really adjust everything here in the way that I actually need it. Of course, we also have the option here to simply look at the different trades. Yes, that means, for example, we could take another look at the long trades here now. The long trades are looking very good overall. We have a total of 18 winning trades here, 25 trades in total, with 7 of them being losing trades as well. And of course, we can do exactly the very same thing here now for the short side as well. Here as well, we can clearly see that we naturally have significantly fewer trades here. 5 winners and 3 losses. We also have a fairly high drawdown here. That means that here as well, we could of course first go into the short trades and take a closer look at where the losses actually came from. So of course we can also take a slightly closer look in here first. That means that here we have 1, 2, 3 losing trades. So we can see that in this particular case we get stopped out by 1, 2 ticks before the market actually goes down. What's happening here? Yes, basically the very same thing here too. And now, of course, we could take a closer look at whether we can adjust the whole thing once again here by using the risk parameters. That means we're moving the stop. I would just go ahead and move it by 20 ticks and then test the whole thing here once again. Yes, and I can see that I have a noticeably better result here now. I do need to do the cross check for the long direction right away. That means, of course, it really shouldn't get any worse either. That one is also getting better at the moment now. And of course, I could say, okay, we'll go a little bit higher here once again. So, of course, you always have to keep in mind that the TP will then end up getting farther and farther away as time goes on. Yes, but that still really doesn't look all that bad. How does it look now for the short direction? Yeah, for the short direction, I think it has actually gotten a little bit worse now. Let's just go ahead and check it one more time. Yeah, I'd probably just leave it like that for both directions then. And now take another look at the result once again. Yes, that means we would be sitting at 25,000 here right now. Yes, there's one more thing that you can generally keep adjusting repeatedly again and again. That means, especially right at the very beginning of a 4-hour candle, it can of course happen that you end up getting some false trades there. That means we need to set a certain minimum distance requirement. So let's say we set a minimum distance requirement of 30 ticks from the high. That means we also want to leave a bit of extra room to the upside. And of course, I want that same kind of room on the downside as well. Here as well, I'll go ahead and test 30 ticks. Let's run it one more time. Yes, now I can clearly see that I definitely only have 30 trades in total, 23 winners and just 7 losses. That means my risk reward ratio is at 1.94 and my win rate is 76%. It's now set to a complete 60-day period. That means it's roughly 1 trade every other day. Of course, I can scale this whole thing up as well. That means either scaling through the accounts, or I can just say I'll simply take 2 contracts right here. And that means if I take 2 contracts, I'm sitting at $52,000 right here within 60 days. I need to understand that clearly. I could just as easily choose to go with 4 contracts instead. Then at least I also have a really good headline for YouTube, 103,000 within 60 days. The big question is, how realistic is that? And of course, it always has to match the account size. I mean, sure, if I'm making 103,000 here in 60 days, I can also risk $6,000. But of course, I can't really do that if I'm working with an account that has only a $2,500 drawdown. Yes, I need to be very clear about that. Just one candle here could already stop me out of a setup if I'm in with 2 contracts. Yeah, I must never underestimate it or forget it. That's why it's better to reduce the position size a bit and make sure you first trade an account up properly and consistently. Yes, let's just take another closer look at the result here. What you, of course, have to take into account is that this is now 60 days. The other one was only 20 days. And across these 60 days here, we ultimately ended up with just 30 trades in total, 23 winners and 7 losers. The win rate comes in at 76%, the CAV is 1.94%, and the drawdown is 1,595. Yes, so that means I can, of course, keep setups open for a significantly longer period of time. However, it's always the case that I then automatically end up with a smaller number of trades overall. Yes, 30 trades over 60 days means roughly 1 trade every second day. That also means that if I'm now looking for a setup that gives me trades every single day, then it's probably not the right setup. But if I do this across several different markets, then the probability is actually quite high that I'll get a setup every single day in at least one market. Okay, that's it. I wish you good trades, lots of success, and see you next time.